Hello again, welcome to video 4 of the series of 7 videos designed to assist you with your stage 5 of your company creation project. We are over halfway through these tutorials, so hang in there. This particular video is designed to assist you with part 3 of this stage, which is labeled as a cash flow statement on your assignment sheet. It also correlates to the third tab on this Excel file. If you recall from your book, the definition of cash flow statement is it's a financial statement that identifies a firm's sources and uses of cash in a given accounting period. So essentially it is tracking the cash that is both flowing into and out of your company. If you recall, one of the most important asset, most valuable asset of a company is that company's cash. A lot of companies potentially run into problems when they don't properly manage their cash. Hence the term of cash is king, which is why there is actually this entire statement that's designed to keeping track of the cash of a company and understanding how it's flowing in, how it's flowing out, to ensure that the company in essence does not run out of cash at a time when it potentially would need it. So the cash flow statement is broken into 3 main categories. The first is the operating cash flow. The second is the investment cash flow, and the third is the financing cash flow. So the operating cash flow correlates to the cash that comes in and out of the company as it relates to the company's operations. So you first have the cash from sales. So you'll notice this $60,000 equates to the value of $60,000 right here. So it's how much cash is coming into the company as a result to the sales that you identified in terms of the quantity that you were anticipating selling and the price that you were selling it at. This initial inventory purchase correlates again to this portion of the spreadsheet. That number of $200 is right here. It's how much money that you anticipated spending on that initial inventory cost based on your quantity and the cost of inventory. So that's where that 200 comes into play. Your cost of inventory, that's the cost of the inventory that's connected with the sales number right here. So this is $36,000. So if we go back over here, that's your cost of goods sold of $24,000 plus your shipping cost of $12,000. So 24 plus 12, that's where you get to your $36,000 cost right here. And then you have your operating expenses and taxes. So those expenses will appear in right here, this $15,600. It's a little bit higher than this $15,600 because with the formulas that are already integrated into this spreadsheet, it's accounting for additional taxes that was not originally reflected in this expenses sheet. And so that gives you a total of $5,260 of a positive cash flow. If it was negative, it would show actually parentheses around this 5260. And the way that we got this number is we had the $60,000 coming in. We subtract the 200 coming out for your inventory purchase, we subtract the cost of inventory, and then we subtract this operating expenses and taxes. So that's all that first category is operating cash flow. There's no additional decisions that you'll need to make as it relates to this portion of the assignment, but it's important to understand how this is all playing out and how this impacts your potential cash flow. The next part is your investment cash flow. So this relates to the investments that you potentially will be making in assets such as land, equipment, and buildings. The sales of land or equipment, that would be if your company currently owns land or equipment. At this point in time, since you are a new company, we're going to make the assumption that you do not own any of this. So although there's a space to input a value in here, you want to keep this at 0. But again, if you want to use this, these Excel sheets to help you, if you want to explore a little bit more, or perhaps you end up pursuing opening this business for real, or maybe you already are running this business, you can use this as a tool. But for the purposes of this assignment, this will remain as 0, so I'm going to go ahead and put the 0 in there, and you'll notice it'll just stay like that whenever you put a 0 value into this. For the purchase of land and building, so this would be if you needed to, as it seems, buy any land or building for your company, as opposed to if you were going to rent either of these things, that would be reflected back on your fixed monthly expenses. So for the purpose of this assignment, we're going to assume that the equipment that we'll need to purchase is $1,000. So I'm going to put 1,000 right in here. And we're going to assume that we're not going to buy any land or equipment. So again, that will be 0. And then it'll just be reflected right there as it was before. So right now, this is what I was talking about before, because it's a negative value. You did not make any money off the sale of land. You spent money on the purchase of equipment for $1,000. Your cash flow right now is $1,000 in the negative of flowing out of your business. The final component of your cash flow statement is called your financing cash flow. That's cash that's either flowing into or out of your company as it relates to capital that you've raised, either by yourself as an owner or investors. And so there's a couple different types of investors: venture capitalists and angel investors, and you'll learn about the differences of those, or you have hopefully already learned about those in your book. Or you've raised money or borrowed money rather by taking out a loan or acquiring credit card debt. And this payment to debt would be if you have already taken out a loan or credit card debt and you are deciding to pay it off. Again, for the purpose of this assignment, since we're starting fresh, we assume that at this point in time you do not have any of this debt, so you'll want to keep the payments to debt 0 for this assignment. So some of the decisions that you will need to make as it relates to this portion of the assignment is, first, you'll need to decide how much, if you need to purchase land, building, or equipment. Again, you'll want to justify that, whether you are going to purchase those things versus perhaps renting, or perhaps none of the above. Maybe you don't need equipment or land or building. So you want to make a decision and have reasons to back that up. And again, you'll want to justify the numbers that you include in here. If you're purchasing equipment and you say it's $1,000, well, where did you get that value from? How do you know it's $1,000? So that's the first set of decisions that you'll make as it relates to this cash flow statement. The second set of decisions is to determine how much what's called startup capital that you will need to raise to start up your company. That is, how much money do you need to be able to start running your business? For the purpose of this assignment, and this is listed on the assignment sheet, what we're assuming is that in order to start the company, you'll need to factor in the initial inventory cost. So I'm actually going to pull up a calculator right here so you can see these calculations. So the initial inventory cost, if you remember, back on this sales sheet was that $200. So we'll go back to the cash flow, pull the calculator up. So we've got $200 right here. So you want to factor that in. We also want to have 3 months, minimum of 3 months of administrative overhead and other expenses. So let's go to our expenses category. So 3 months would be all the expenses for your administrative, your overhead, and your other expenses. So the total right here as it relates to my fictitious company is $1,300 per month. So if you would want to do that for 3 months, you would do 1,300 times 3 for 3 months. That would get you to $3,900. So we do add $3,900 to the 200 right here. Now we're at $4,100. And the last thing that I've asked for you to include is in terms of determining what your startup capital is that you need is the initial cost of any land, buildings, or equipment. So again, for this particular example, I've made the decision that I need to spend $1,000 in the purchase of equipment. So I'm going to add $1,000 to this initial startup capital. So this number is telling me that in order to start my particular fictitious company, I need to have $5,100 in money raised in order for me to realistically start operations of my company. Of course, this number will be different for your particular company depending on what you've decided, the decisions that you've made in these prior stages. So this $5,100 right here should appear right here at the bottom of this subtotal. This is showing how much money you have raised. So then the next decision is, now that you know how much money you need to raise, now you need to decide, okay, how are we going to raise it? And that's where these different types of financing comes into play. And there's certainly information about the benefits and weaknesses of these various types of raising money in your book. So I'd encourage you to read through there and use that as to help support your justification in terms of how you're going to raise the capital that you are. But either way, we need to make sure that we get to this $5,100. So for the purpose of this example, I'm going to assume that 1,000 of those dollars came from paid in capital by owners. So that is, if I'm the sole owner of my company, or you have a team of 5 and all 5 of you are the owners of your company, you have committed to contributing $1,000 of your own personal cash as part of your startup capital. I've also decided I was able to get a venture capitalist to contribute $2,000 as part of my startup cost, which, by the way, as part of your final stage of the company creation project, you'll actually be pitching your company to potential investors. That's what your final video pitch will be. So that's something to keep in mind as you make decisions in terms of determining how much money you'll want to be raising from potential investors and whether that's realistic. So this is $2,000 right here, and then the remaining amounts to get me to my $5,100, I'm going to take out a loan for $2,100. So I'm going to put the $2,100 in here, and this is where you'll see you have an amount of $5,100, which is the amount that we wanted to get from the begin with. You notice there's different types of financing. You've got equity financing versus debt financing. So the equity financing is money that's taking out of the value of your company, versus the debt financing is money that you are now owing as part